you're not going to ramp up the private sector to replace the lost public spending. So the bottom line is, they said the U.S., given all the constraints on our ability to make our interest rates lower and wages lower and all that kind of stuff, basically they say we can't go more than 1% a year and do everything we can in terms of regulatory, supply side incentives to grow. And so if we can only go 1% a year and we're already at 10, and we're just at the beginning of the baby boomers, I don't see any end to this except accumulating a lot more debt faster than we can adjust to it. So I've become extremely pessimistic, to say the least. All right, solution number 2 is default on debt. So you can see why I go to it as a semi-realistic thing. There's costs and benefits. The benefit, obviously, is you walk away from your debt. The cost is, in one way, we got that monkey off our back, and it's really too early to do it. Wait till we really get a lot of it. But in other words, a strategic default, if we did it now. The problem is there's a big cost associated with it. And the cost associated with it is the U.S. government debt is someone else's asset. So if you write off the debt, the wealth in the country diminishes. And who tends to hold that asset are insurance companies, commercial banks, and financial institutions, and pension funds. So suddenly your pension's not getting paid, and your banks are out of business. So the walking away from country debt also crushes wealth. So you start accumulating wealth again, which means very high savings rates. So on one hand, you got rid of the monkey off your back. On the other hand, you got to keep, you're going to have an austere economy from it as a result. I don't know, after a while, you get there, and you might think it's outrageous, but you take a look at the statistics on the number of countries that have done it. It's only unusual and never happened in the United States, but there's a whole long list. I was going to bring the list in, and there are an awful lot of countries that have done it. Here's the profile. The profile of what ends up being on the causing side is you have too much debt relative to income, and we sure qualify, both at the federal level and the personal level. That's the first generalization you can walk away with. The second is when these sovereign defaults occur, they tend to have a lot of contagion with all their neighbors. They bring other countries down. So they happen in rashes, in a certain decade, like in the 1990s in Southeast Asia and the emerging nations, and all through history. And then you'll have 2 or 3 decades with hardly any, if any, and then suddenly a big block of them goes down. And the block that goes down are trading partners. So the demographic, if there's one variable you can put your finger on that identifies a problem waiting to happen, is when your total indebtedness relative to income gets out of control. And we're certainly there. We're actually, I have to say, if we didn't have the entitlements of the baby boomers, we could handle what we have. But it's the next 60 billion that's coming, 60 trillion that's coming, we can't handle. We can handle what we have and squeak by. And it would be a tough squeak, but we could squeak by. All right, the third possibility, which I think is the most likely, is one way or another we monetize the debt, which is economists' jargon for what we saw a year ago with the Fed. You get into a situation where the debt starts to get out of hand. One way you can reduce the burden of debt is to have some inflation so that we get paid instead of $5 bills, we get paid in $10 bills, so we can pay off past debt that is fixed in price, something we did in the 70s and became very easy to pay debt off in the inflation we had. So it basically reduces the burden of the debt. And I have to say, very subtly, you're probably not linking up Ben Bernanke with that idea, but that's exactly what he did a year ago. What was the rationale for QE2? Well, we don't want to have deflation, which is another way of saying we got to have a positive inflation rate. And he's been successful. He's got it up to 4 at the core rate, and the other rate is more like, I think, 6 if you include oil. And so he went from near 0, we went from about 1 to 6. And he didn't say, as my objective, he couldn't say it, to raise the inflation rate, because then you'd have people diving out of bonds, which ends up being my advice to you at the end of this day. Because you're trying to sell the treasuries. And basically, he's creating an environment to make the debt burden less, but there's less incentive for you and I to hold the stuff. So when you get to monetization of the debt, there's really two phases, two ways to look at it. Either by intent or because that's all you can do. And the intent is what we saw last year. The intent is we're going to run the printing press and buy treasuries to the tune of $600 billion in 9 months, which is, as I said, a 15 to 20 year buy in 9 months. And the purpose, he said, was to prevent deflation. By the way, one of the Fed presidents who votes on the next meeting from the Philadelphia Fed has already gone on record in the Financial Times saying he proposes a target of a 5% inflation rate. Expect to hear that kind of stuff. So whether they say it or not and come clean and say it, they're more likely not to come clean and not say it because they don't want to create expectations, because the expectation is don't buy treasuries and get your capital out of this country. So the Fed has to come up with, well, we got to attack unemployment, we got to attack this and that and this. So inflation by intent, I think, and by the way, here we are with the Fed having the Fed tripled its balance sheet. Over the previous 100 years, it was $800 billion. Now it's $3 trillion. So they did 200 years worth of expansion in the last 4. And now they're meeting again on the 21st and 22nd to come up with something new. They're not going to save money because that became a dirty word because it all created inflation and inflation expectations. They're going to make the announcement in terms of interest rates. Now, what you're going to expect, I wouldn't be surprised if you're going to see something you've never seen before, and that is not only from the Fed, but possibly from the U.S. government. And that is, one way out of this is for the Fed to charge commercial banks who deposit with the Fed a fee. In other words, a money tax. If you don't lend, we're going to charge you 2 or 3 or 4% a year. And that's a plausible answer from their perspective. They can pull it off because we got over $1 trillion by commercial banks' liquidity deposited at the Fed for safekeeping at a low interest rate, so they could take the low interest rate and go from +0.25% to -2 or -3 or -4, and say you leave it with us, you're going to lose every year, and you got to recognize it on your balance sheet, or you go out there and make a loan. Either way, you're cooked, but at least the other one, we have maybe we have a Hail Mary, maybe someone will catch the ball. So the Fed is down to things like that. And the last possibility of this is inflation, not by intent, but just simply that is politically the only answer. Namely, if you can't politically, and it certainly looked that way last summer, you couldn't get the two parties to agree on something that would cause the two ends to meet in the middle and get to the budget balance. And I don't see that that's much different going forward. Remember, we've had that situation for 25 years. And you think about it, I think the numbers are something to the effect close, like 44% of families pay taxes and 44% of families get U.S. government benefits. So we're split. So how can you have a coming together on that? So then if you can't have a coming together on that, then you keep trying to pay the entitlements, and then you keep trying to sell the treasuries, and the market quits buying it, and then you cram it down the throat of the central bank. And the central banker has to be changed because Bernanke, I think, will draw the line, but his term is up in about 2 years, and that's going to be easy to get him to go back to Princeton. I don't think that's a problem. But on top of that, the Treasury Department Congress doesn't even have to scare off the Fed or twist their arm to buy the debt, as they did in QE2. We could go back to something I mentioned before, and I find myself at night going to Wikipedia and looking up something called U.S. notes. In the Civil War, we were in the same situation. The tax revenues, we had no general taxation during the Civil War. You're fighting a civil war, and you can't tax. So your revenue sources are very limited. So they ended up going to printing money at the Treasury, not the central bank. And guess what? That legislation's still on the books. All they got to do is change the date. And actually, on the books, the U.S. note looks just like a Federal Reserve note. The only difference is at the top of it, instead of saying Federal Reserve notes, it says United States note. Otherwise, it looks the same. The only other way the difference was the crest was red instead of green. So if you got it, and by the way, they're still out there, they're still floating around. They've quit printing them any longer. So all you have to do is change the date under which they put a, so Tim Geithner can print his own money. And as long as it has legal tender status, along with the Federal Reserve status, now you have two money issuers. If somehow or other we leave the Fed as a sacred cow. During World War II, the same thing came up, where the Fed had to buy the government debt. And they volunteered to be the monetizer. The reason they volunteered 80, I think it was 86 days after Pearl Harbor. The Fed went to the Treasury and volunteered to be the buyer of last resort because they knew the Treasury would be knocking on their door, so they thought they'd get a better deal if they went to them first. And the deal they got was, when the war is over, the deal's off. And the Treasury says, okay, we're the ones who decide when the deal's off, when the war is over. Treasury decided the war was over in 1950. This is true. That's one of the most interesting episodes of history, of inside politics. Actually, they waited till the Secretary of the Treasury was in the hospital being anesthetized, and the Undersecretary cut a deal with the Fed that we will free you from the agreement. You can go back to be independent and no longer under us on the terms that I become the chairman of the Fed. And that's exactly how it went down. And for $64, name who it was. He served as Fed chairman for 20 years. In fact, I met him. He didn't seem that sleazy to me when I met him. But in any event, long story short, I think we're going to monetize, because if you can't come to an agreement on going through the pain of balancing and walking away from the entitlements, which are pain, because it's not just a pain of the voters, the politicians telling the voters, but basically the economic pain of the austerity we're going to go through. And I don't think we can ramp up the private sector enough. So then it leads us to the question, what do you do with your own money?